Hello students, hope you all are good. Today we will start Unit 3 Salient Features of the Banking Regulation Act Recent Trends in Indian Banking, that is e-banking or innovative banking. In last section we will discuss about RBI, roles of RBI, objective of RBI. As we all know, for RBI Banking Regulation Act also works. So today we will discuss about it. Overview: Banking Regulation Act establishment, objectives of the Banking Regulation Act, salient features of the Banking Regulation Act, defines e-banking, features of e-banking, types of e-banking, recent trends in Indian banking. Banking Regulation Act establishment. The Banking Regulation Act 1949 is a component of central legislations that governs all Indian banking institutions. It is known as the Banking Companies Act and is one of the essential pieces of banking legislation. It went into effect on March 16, 1949, but was later renamed the Banking Regulation Act 19 in 1966. Since 1956, it has been in effect in Jammu and Kashmir. Initially, the requirements of this legislation exclusively applied to financial institutions. However, following the 1965 modification, it also applied to cooperative banks. The Reserve Bank of India has the authority to establish banks and supervise their shareholding under Banking Regulation Act. It also gives the RBI authority over board appointment and management. The RBI can also give auditing instructions, merger and liquidation controls, and banking policy directions. Objectives of the Banking Regulation Act. The Banking Regulation Act got enacted with the following objectives in mind. First, to provide precise legislation with comprehensive provisions, especially for the banking industry in India. Second, to prevent bank failures by establishing minimum capital requirements. Third, to assist banking companies in developing in a balanced way. Fourth, to provide the RBI with the approving the appointment, reappointment and dismissal of bank chairmen, directors and officials. Fifth, to protect depositors' interest. Sixth, to assist in the strengthening of the country's financial system, to establish the banking laws in India. Salient features of the Banking Regulation Act. A broad definition of banking is to put any entities that accept deposits refundable on demand or otherwise for lending or investment within the ambit of the law. Non-banking institutions are prohibited from accepting demand deposits. Trading is prohibited from removing non-banking concerns. Minimum capital requirements are imposed. Dividend payouts are being restricted. Inclusions of banks established outside India's provinces in the scope of the law. Implementation of a comprehensive licensing system for banks and their subsidiaries. Prescription of a specific type of balance sheet and Reserve Bank's authority to demand periodic returns. The Reserve Bank inspects a bank's books and accounts, providing the central government with the authority to take measures against banks that conduct business in a way that is harmful to depositors' interest. Provision for increasing the RBI interaction with financial institutions. Provision of a fast track liquidation procedure, including the Indian Reserve Bank in bills provision, increasing the Reserve Bank of India's capabilities to aid banks in time of crisis. Defines e-banking. The following terms refers to one form or other of electronic banking: personal computer banking, internet banking, virtual banking, online banking, home banking, remote electronic banking, and phone banking. Electronic banking is an umbrella term for the process by which a customer may perform banking transactions electronically without visiting a brick and mortar institution. E banking is defined as the automated delivery of new and traditional banking product and services directly to customers through electronic interactive communication channels. E-banking includes the systems that enable banks, customers, individuals, or businesses to check accounts, do or transact businesses, or obtain information on financial products and services through a public or private network, including the internet. Customers can avail e-banking services by using an intelligent electronic device such as personal computer, personal digital assistant, automated teller machine, kiosk, or touch-tone telephone. Features of e-banking. Online banking solutions have many features and capabilities in common, but traditionally also have some that are application specific. The common features fall broadly into several categories. First is transactional and second is non-transactional. Firstly, we will discuss transactional feature. Example: performing a financial transaction such as an account to account transfer, paying a bill, wire transfer and applications, apply for a loan, new account, etc. These all are transactional features. Electronic bill presentment and payment, that is EBPP, funds transfer between a customer's own checking and saving accounts or to another customer's account. Investment purchase or sale, loan applications and transactions such as repayments. Non-transactional features. Examples are online statements, check links, co-browsing, chat, etc. Bank statements, financial institution administration, features allowing the financial institution to manage the online experience of their end users. Hosting administration, features allowing the hosting company to administer the solution across financial institutions. Types of e-banking. Online banking. This is the most basic form of e-banking where customers can access their bank accounts, view balances, transaction history, and transfer funds between accounts using a bank's website or mobile app. Online banking also often includes bill payment options and the ability to manage account preferences. Second, mobile banking. Mobile banking refers to using dedicated banking apps on smartphones and tablets to conduct banking transactions. It offers similar functionalities to online banking, but with the added convenience of being accessible on the go. Third, ATM banking. ATMs, that is automated teller machines, have evolved to provide more advanced services such as cash deposits, check deposits, fund transfers, and even bill payments. Some ATMs also offer video conferencing capabilities for customers to interact with bank representatives. Fourth, phone banking. Customers can perform banking transactions over the phone by using an interactive voice response IVR system or by speaking to a customer service representative. This method is particularly useful for those without internet access or smartphones. Fifth type, mobile wallets. Mobile wallets, also known as digital wallets, allow users to store payment card information securely on their smartphones. These wallets can be used to make payments at point of sale terminals, online merchants, and even peer to peer money transfers. Sixth, electronic fund transfer EFT. EFT involves transferring funds electronically from one bank account to another. This can include direct deposit of salaries, electronic bill payments, and transferring funds between accounts at different banks. Seventh, online bill payment. Customers can use online banking platforms to pay bills to various merchants, service providers, and utility companies. This eliminates the need for paper checks and postage. Eighth, mobile payments. Mobile payment services like Apple Pay, Google Pay, and Samsung Pay enable users to make payments using their smartphones at contactless payment terminals. These services like a user's credit or debit card information to their device for secure transactions. Ninth, virtual banking. Some banks operate exclusively online without any physical branches. These virtual banks offer all their services through digital platforms, catering to customers who prefer the convenience of online banking. 10th, peer to peer transfers, that is P2P transfers. P2P platforms allows users to send money to each other directly, often using just the recipient's email address or mobile number. These services are commonly used for splitting bills, repaying loans, or sending gifts. 11th, online investment and trading. Many banks offer online investment platforms where customers can buy and sell stocks, bonds, mutual funds, and other financial instruments. These platforms also provide tools for research and portfolio management. 12th and last is online loan applications. Customers can apply for loans and credit products through the bank's online portal, often speeding up the approval process due to automated verification and processing. Recent trends in Indian banking. First is e-banking evolution. The rise of digital technology has led to the rapid growth of electronic banking, offering services like online account management, fund transfers, and bill payments. Second, mobile banking. The proliferation of smartphones has driven the adoption of mobile banking apps, enabling customers to access banking services on the go. Third, internet banking. Online platforms allow customers to perform transactions, view statements, and manage their accounts via web portals. Fourth, UPI and digital payments. The Unified Payment Interface UPI revolutionized peer to peer and merchant transactions, promoting cashless payments. Fifth, innovative payment solutions. Introduction of digital wallets, contactless payments, and QR code based transactions have transformed payments methods. Sixth, AI and chatbots. Banks are leveraging artificial intelligence to provide personalized customer support and streamline query resolution. Seventh, blockchain applications. Some banks are exploring blockchain technology for secure and transparent record keeping, especially in cross border transactions. Eighth, fintech collaborations. Banks are partnering with fintech startups to offer innovative financial products and services, enhancing customer experiences. Ninth, cybersecurity focus. With increased digital interactions, banks are investing heavily in robust cybersecurity measures to safeguard customer data and transactions. Thank you. The session is over now.